Good afternoon, everyone. Colleagues, members of the press, welcome. Since the previous meeting of the Monetary Policy Committee, the global growth outlook has weakened further. However, the near-term risks to global financial markets arising from the Eurozone debt crisis seem to have subsided somewhat following the announcement of the bond purchase program by the ECB. While this appears to be a positive step, significant risks still remain. At the same time, the global environment has been impacted by further monetary easing in both the United States and Japan. Domestically, inflation continued to surprise on the downside, although it appears that the short-term low point could have been reached. Despite a number of upside supply-side risks, inflation is expected to remain contained within the target range over the forecast period. The growth outlook, however, has deteriorated somewhat in response to both domestic and global developments. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas was 5% in August 2012, up from 4.9% in July. The categories of food, housing and utilities, and transport together accounted for 3 percentage points of the inflation outcome. Food prices increased by 5.1%, petrol by 9.3%, and electricity by 10%. Core inflation, as measured by the exclusion of food, petrol and electricity from CPI, measured 4.6%, up from 4.5% in July. Administered prices, excluding petrol, increased at a year-on-year rate of 7.5%. Year-on-year producer price inflation moderated to 5.4% in July, having measured 6.6% in each of the previous 3 months. A reversal in the downward trend in food price inflation was observed, although still at relatively low levels, with agricultural prices increasing at a year-on-year rate of 3% in July, compared with a recent low of 1.7% in May and 2.2% in June. Manufactured food prices increased by 7.7% and 8% in June and July, respectively. The inflation forecast of the bank reflects a moderate deterioration for 2013 compared with the previous forecast, and a relatively flat trajectory over the entire forecast period. Inflation is now expected to average 5.3% in the final quarter of 2012, 5.2% in 2013, and 5% in 2014. The near-term deterioration is mainly due to higher expected petrol and food inflation. Core inflation appears to be well contained, with a peak of 4.9% expected in the final quarter of 2012, compared with the previous forecast peak of 5.4%. This measure is now expected to average 4.6% in both 2013 and 2014. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the third quarter of 2012, were again virtually unchanged, particularly for 2013 and 2014, and remain anchored at around the upper end of the target range. Respondents expect inflation to average 5.8% in 2012 and 6% and 6.2% in 2013 and 2014. There is, however, a divergence of views between the respondents. While all categories of respondents expect average inflation to be within the target range in 2012, trade union officials and business executives expected to exceed the upper end of the target range in both of the following 2 years. This is in contrast to financial analysts who expect inflation to average just over 5% in both of these years. The survey conducted by Reuters indicates that market analysts expect inflation to average 5.3% in 2013 and 5.4% in 2014. Market expectations, as reflected in the break-even inflation rates, initially increased after the previous meeting of the MPC, but have since declined somewhat. Expectations over the various maturities continue to reflect expectations of inflation within the target range. The global growth outlook remains weak, notwithstanding significant policy initiatives announced by the US Fed, the ECB, and the Bank of Japan, and the initial positive reaction from global financial markets. The decision by the Fed to engage in a further round of quantitative easing was prompted by an assessment that the expected growth trajectory was not strong enough to generate a sustained improvement in the labour market. The US economy grew at an annualized rate of 1.7% in the second quarter of 2012, and the outlook is clouded by the risk of a severe fiscal contraction early next year. The outcome of the US elections in November will be critical in determining the prospects for a favorable resolution of this fiscal cliff. In the meantime, the attendant risks have had an adverse impact on investment expenditure in the US, and various indicators of industrial output point to a subdued growth outlook. In the Eurozone, the immediate risks posed by the continuing debt crisis appear to have abated somewhat with the announcement by the ECB of its outright monetary transactions, or OMT, or bond purchase program. In addition, two important event risks were also avoided following the decision of the Federal Constitutional Court in Germany to uphold the ratification of the treaty to establish the European Stability Mechanism, although under specific conditions, and the pro-Euro outcome of the Dutch election. The precise workings of the OMT, particularly the issues relating to conditionality, are still uncertain, but the initiative has bought some time to implement more permanent solutions. Despite this potential progress, the risk of a Greek exit from the Eurozone remains, and growth prospects in the region have deteriorated following the overall contraction in the second quarter of this year, continued bank deleveraging, and a further decline in cross-border lending. The United Kingdom economy has contracted for 3 consecutive quarters, while Japanese economic growth also moderated markedly in the second quarter. The impact of the US actions on the Japanese yen prompted a surprise increase of 10 trillion yen by the Bank of Japan in the size of its asset purchase program. Although the yen depreciated in response, the impact appears to have been short-lived. Growth momentum is also somewhat weaker in some of the systemically important emerging market economies, particularly in China, Brazil, and India, in the face of weakening external demand. A number of countries have responded by easing monetary policy and, as in the case of Brazil, by introducing measures to stimulate domestic demand and competitiveness. Global inflation remains relatively benign given the weak demand, but supply-side shocks in the form of higher food prices due to droughts in the US and some parts of Eastern Europe, and resilient international crude oil prices pose a risk to the outlook. Both of these shocks are not only a risk to inflation, but could also represent an additional drag on near-term growth, a combination that poses enormous challenges to monetary policy. The Rand exchange rate has fluctuated generally within a range of 8 Rand 10 to 8 Rand 50 against the US dollar since May, and continues to be affected by changing risk perceptions in global financial markets. More recently, the Rand appears to have decoupled from the euro and reacted to domestic issues, including the wider-than-expected current account deficit and developments in parts of the mining sector following the tragic events at Maracana. The Rand has, however, been underpinned to some extent by continued inflows into the domestic bond markets in the lead-up to South Africa's inclusion in the Citibank World Government Bond Index, the WGBI. Non-resident purchases of South African bonds have amounted to 12 billion Rand since the previous meeting of the MPC, and to 74.5 billion Rand since the beginning of this year. These inflows are expected to persist for some time as non-resident portfolios adjust to the WGBI inclusion. Although the Rand, along with most other currencies, initially appreciated against the dollar following the announcement of further quantitative easing by the US Fed, it depreciated against the euro following the positive response to the announcements of the OMT. Since the previous meeting of the MPC, the Rand has depreciated by about 2.4% against the dollar, by 7.5% against the euro, and by 5% on a trade-weighted basis. Over this period, the dollar depreciated by 5.5% against the euro. The current account of the balance of payments has emerged as a risk to the exchange rate outlook following the widening of the deficit to 6.4% of GDP in the second quarter. The bank's forecast for the current account in 2012 is for a deficit in the order of 5.25% of GDP. This widening deficit is a consequence of declining commodity exports and increased imports and service payments. The current account deficit has been financed mainly through portfolio inflows, but could pose a risk to the exchange rate unless it moderates over the coming months. The domestic economic outlook remains constrained by the weak global outlook and by recent work stoppages in the mining sector. The economy recorded a growth rate of 3.2% in the second quarter of 2012, but this reflects a distortion arising from the strong contribution from the mining sector, which recovered from a deep contraction in the first quarter. Non-mining real output growth measured 1.7%, due in large part to negative growth in the manufacturing sector. The leading indicator of the Reserve Bank has declined for 4 consecutive months, and the bank's growth forecasts have been revised down. Real GDP growth is now expected to average 2.6% in 2012 and 3.4% in 2013, compared with 2.7% and 3.8% in the previous forecasts. Notwithstanding these downward revisions, the bank sees further risks to the downside. Recent high-frequency data point to a lackluster growth performance in the third quarter. Mining output contracted by 1.5% in July compared with June, and the impact of the recent strikes in the mining sector is yet to be reflected in the data. The physical volume of manufacturing production contracted by 1.1% on a month-on-month basis in July, while the year-on-year increase of 5.8% was exaggerated by weak base effects. The Kagiso PMI, which has been moderating consistently since February, declined further in August and remains marginally above the neutral level of 50. The FNB-BER Business Confidence Index improved in the third quarter following the sharp decline in the second quarter, but remained below the neutral level. The survey reflected very negative sentiment among manufacturers and building contractors, while the vehicle trade exhibited high and rising levels of confidence, as reflected in robust vehicle sales. The real value of building plans passed declined in June and July after a tentative recovery in the previous 2 months. While positive growth was observed in the non-residential sector up to June, building activity in the residential sector remained subdued, indicative of the weak housing market. By contrast, confidence in the civil construction index has improved, in line with increased civil construction activity. Growth in gross fixed capital formation increased to 5.7%, contributing 1.2 percentage points to overall GDP growth. Private sector investment remains weak, with annualized growth rates of 1.8% and 2.4% in the first and second quarters of 2012. By contrast, fixed capital formation by public corporations grew at an annualized rate of 9.1% in the second quarter. Formal sector employment growth has remained weak. According to the quarterly employment statistics, or QES, released by Stats South Africa, employment growth over 4 quarters to the second quarter of 2012 measured 1.5%. This represents an increase of 123,300 jobs, 1/3 of which were in the public sector. Although the current level of formal sector employment is still about 60,000 less than that attained before the onset of the crisis, the trend remains positive, even if too slow. Final consumption expenditure by households was again the main contributor to GDP growth, contributing 1.9 percentage points. Nevertheless, expenditure growth moderated to 2.9% in the second quarter, mainly due to the contraction in real outlays on services. Expenditure on goods, particularly durable and semi-durable goods, remained robust. Retail sales also grew at a more moderate year-on-year rate of 4.2% in July. Despite the decline in total new vehicle sales in August, the positive momentum in the sector seems to have been sustained, although exports to Europe are expected to remain under pressure. The FNB-BER Consumer Confidence Index increased marginally in the third quarter, following a large decline in the second quarter, but remains at a low level. At these levels, consumption expenditure is not seen to pose a risk to the inflation outlook. Following a recent high in March 2012, growth in credit extension to the private sector has moderated. 12-month growth in banks' total loans and advances declined from 9.2% in March to 8.1% and 7.3% in June and July, respectively. Credit extension to the household sector increased at a rate of 8.1% in July, while credit extended to the corporate sector eased somewhat. Mortgage loans remained subdued, while installment sale credit and leasing finance reflected the robust vehicle sales. Growth in general loans to households, which is mainly unsecured lending, accelerated to 32.8% in July, but was still below the peak growth of 39.3% experienced in June 2011. Growth in unsecured lending to companies moderated to 8.3% in July from a recent high of 16.1% recorded in March. The continued higher rates of unsecured lending have contributed to rising household debt, with the ratio of household debt to disposable income increasing from 75.6% to 76.3%, between the first and second quarters of 2012. There is no evidence that unsecured lending has had an adverse impact on the asset quality of the banking sector, as impaired advances as a percentage of gross loans and advances measured 4.4% in July, compared with 5.5% a year earlier. The trends in wage growth have been relatively benign from an inflation perspective. Measured over 4 quarters, nominal unit labour cost growth was 6.1% in both of the first 2 quarters of 2012. According to Andrew Levy employment publications, their overall wage settlement rate in collective bargaining agreements amounted to 7.7% in the first half of 2012, while the public sector settled on an increase of 7%. However, there is a risk that the recent wage settlements in the mining sector could set a precedent for wage demands more generally. Food and petrol prices are the main upside risks to the inflation outlook. Following a sharp spike in July, global grain prices stabilized and then moderated, but remain at elevated levels. Futures prices indicate an expectation that these prices may have stabilized and may subside in the medium term. Domestic spot prices of maize and wheat followed global trends, having increased by about 40% and 20% respectively between the beginning of June and the end of July. These increases are expected to filter through to domestic consumer prices in the coming months. The price of Brent crude oil continued its recent upward trend, reaching around $117 a barrel on 14th of September, or $12 a barrel higher than at the time of the previous MPC meeting. However, the Saudi Arabian government commitment to increase the supply of oil has elicited a price response, with oil prices declining to current levels of about $108 per barrel. How sustainable this impact will be remains to be seen, given the geopolitical factors prevailing in the Middle East. The domestic price of petrol has increased significantly as a result, largely offsetting the recent price decreases. Since August, the price of petrol has increased by a cumulative R1.15 per litre, and a further increase is expected in October. The MPC remains concerned about the risks posed to the domestic economy from the global environment. The actions of the ECB appear to have reduced immediate liquidity concerns in the region and have had a positive impact on sentiment. The continued risk of a possible Greek exit and its contagion effects are likely to hang over the markets for some time. The fundamental problem of the Eurozone remains, and low or negative growth is likely to persist going forward. Despite renewed stimulus in the United States, growth is expected to remain subdued at least until the fiscal cliff issue is resolved. This negative global outlook, which is reinforced by a slowdown in Asia, poses a downside risk to the domestic growth prospects, particularly in the form of weaker export performance. The domestic outlook is also likely to be constrained by local developments, particularly in the mining sector, which have the potential to undermine the already fragile private sector investment sentiment, despite the accommodative macroeconomic policy environment. While the bank's forecast for growth has been revised down, the MPC assesses that further risks are somewhat on the downside. Recent inflation outcomes have been more or less in line with the bank's expectations, but some upside pressure is still expected from food and petrol price increases. Demand pressures are, however, expected to remain benign. The exchange rate poses a potential risk to the inflation outlook, particularly in the event of an unsustainable widening of the deficit on the current account of the balance of payments. To date, the rand has remained relatively resilient. The committee assesses the risk to the inflation forecast to be more or less balanced. At its previous meeting, the MPC assessed that conditions justified a preemptive loosening of the monetary policy stance. Although global and domestic growth conditions remain challenging, the MPC is of the view that a further reduction in the repo rate is not appropriate at this stage. The MPC has therefore decided to keep the repo rate unchanged at 5% per annum. This accommodative stance is assessed to be consistent with the bank's price stability mandate and conducive to encouraging growth and domestic investment. Further actions going forward will be highly dependent on global and domestic developments that may change the risks to the outlook. Thank you. We'll now open for questions, and my colleagues on the podium with me will be ready to answer as well. Please just identify yourselves when you ask your question. Mariam.
Good afternoon, Governor. Is the bank at all concerned about the possible impact to economic growth from the strikes in the mining sector? And is the bank also concerned about possible effects on inflation from the high pay settlements we've seen recently?
You had a hand as well.
Francis Machata from Progressive Independent News Agency. How much will domestic economy be affected by the continued labor unrest within the mining communities?
Yes, sir.
Franz Wild from Bloomberg. Just while we're on the subject, if you do expect repercussions from the latest, from the London wage agreement, how long do you think that would take to filter through and to impact inflation, if indeed you think it would?
Let's take those three, and perhaps I'll start and ask colleagues to add. The impact of economic growth from the strikes, it depends, it depends first of all, the mining sector itself. The strikes have been within the mining sector by and large. And that, as we know, the mining sector has been very volatile in terms of both its growth and output. It is a big challenge, as the numbers indicate in terms of growth at this point in time. The first quarter to second quarter numbers from the mining sector have been very volatile. I think it depends on a number of factors. How long are the strikes? What are the settlement agreements? How much it spreads to other areas other than platinum, although we've seen the strikes the strike taking place at Kloof. I think these are very difficult to answer in terms of what its impact on growth would be. I think the question is a broader one, and perhaps that's the political issues that are at stake, is that the whole question of labor relations in this country, the question of fair wages, the question of output and production, certainty of jobs, certainty in the mining sector itself, are very big challenges and need to be addressed by the authorities that are responsible for that. As we've said, is that we see a risk if the high pay settlements set a precedent in terms of what labor relations and settlements are. There has been a very considered approach in interaction between unions and employers about multi-year agreements that recognize a steady progress in terms of wages and the conditions of employment. And this obviously needs to be looked at, and some form of addressing of what seems to be real grievances to take place, but without undermining an organized and systematic and sustainable approach to labor relations in this country. So how much it would impact, I don't know at this point in time. It's far too soon to tell. The question about it relates also to different issues. They relate to the issues of confidence, they relate to issues of investment, and the question that South Africa has a sound economic base, and we need to address the issues that have flared up in the mining sector in specific terms. But I don't think it's possible to give an amount of what it would impact. I think that would be unrealistic at this point in time. Don't forget the issues around wages is not only about wages, it's also about productivity. And you've seen, as I said in the statement, the general settlement and productivity has not been a factor, or largely not a factor in affecting inflation at this point in time. So these are new situations, and we will watch it very closely. I don't know if anyone would like to add something. Yes, sir.
Tsepo Moy, SABC News. I just want to ask on the, you've mentioned that in the past that excess capacity is one of the reasons why inflation will not immediately be, passed through onto consumers. There'll be a delay. So I just want to get your views on that. If you still believe that, that would sort of be a shock absorber. And another question is on the fact that current development in the country, have they ever maybe at some point, and you felt that maybe Governor, it's a sort of a test to monetary policy as a tool, given that you would not have anticipated some of the development? Is it really a challenge or a test to the monetary policy?
Perhaps let me ask somebody to deal with the excess capacity and output Brian, do you want to deal with that, or Rashad? And I'll come to your question of challenges to monetary policy.
I think at this stage we still are seeing excess capacity in the economy, particularly in the manufacturing sector. I think we also do believe, as we mentioned in the statement, that the pressures coming from the demand side are very benign. So most of the risks that we do see going forward come from supply side shocks rather than from the demand side or lack of capacity in the economy.
With regards to whether the current developments are a challenge to monetary policy, we've said consistently, and I'm assuming that you're asking a broader question than simply the issues that have occurred around Marikana and subsequent to that. Because there's a huge challenge to monetary policy and fiscal policy in terms of what your global crisis is experiencing. And we have said consistently over a number of years now that the challenge to growth in the world remains a resolution of the crisis, the financial crisis that pervades the advanced economies. Your synchronized downturn between the US, Europe, UK and Japan is critical to be resolved. And as you've seen, steps taken by all of those central banks require the actions to be taken by the political authorities, because the actions of the central banks can create an environment and create space. But the issues that need to be addressed also need to be done in terms of the political authorities exercising their responsibilities. And that must happen because this, as you know, this is our 5th year of the global crisis, and the outlook is at least another 5 to 7 years. So even if it doesn't get worse, you're talking about another 5 to 7 years. In that situation, South Africa's numbers are very good. I mean, we know perfectly well that growth rates at our levels are too low for our needs, but compared to the very low growth rates in the advanced economies, it's still much more positive. The question of employment creation, although slow, it's still a positive trend. What you're seeing is rising unemployment to horrendous numbers in many parts of Europe. So if one takes that as a challenge to monetary policy, yes, there is a challenge, because the role of a central bank is being expanded all the time. And that has to have challenges going forward as to what the role of a central bank is versus or vis-a-vis the role in the economy of other players, governments and so on. In terms of South Africa, certainly one looks at the challenges to monetary policy in a developing economy, and you've seen very clearly in our own approach, while our prime responsibility and our prime mandate is around price stability, we do that taking into account what is happening in the real economy, what's happening in relation to growth, what's happening in relation to employment, what are the things that we can do, but recognize also there are things that a central bank can do and have effect on. It's not as if you say, well, you know, we would all like to wave a magic wand and solve unemployment. There's certain things that a central bank can do and be effective in. There are things that it needs to be complemented and supported by other actions by different players. So if you look at our unemployment rate, just under 25%, that's a structural unemployment that we have. The central bank, different policy measures are not going to address that structural unemployment. You've got to deal with that through education, through different types of job creation, through a whole range of measures. So it's a complementary question, but there's no doubt that we, as the responsible members, as the executive and MPC members, and don't forget we also have a financial stability mandate, examine all of these issues and take them into account when we take decisions. At the back.
Governor, a question via the webcast from Chris Becker. Are low real interest rates not the cause of the crisis? Should interest rates not be higher in order to encourage real savings and therefore long-term sustainable investment? Thank you.
Who would like to take that? Rashad?
Yeah, I mean, this is a very big debate and has been keeping economists busy for the last 3 or 4 years. Some have argued that thanks to continued low interest rates, this has led to kind of a crisis. Others have argued it's been an exercise in poor regulation. So I don't believe that low interest rate in itself has been the cause of the crisis. There may have been a number of deficiencies in financial regulation in the financial system, that have been by and large responsible for the financial crisis. So it is true that low real interest rates in an environment where there's robust economic growth, the output gap is positive, could contribute to kind of a crisis. But I think under the circumstances, I don't believe that. Having said that, there has been a big debate amongst economists globally on this issue, and there's no resolution on it.
I think that, just to add to that, I think the question of savings is something that's a huge challenge for a country like ourselves. Our savings ratios are far too low. And when you have low interest rates, especially if people are living off fixed income, and the earnings, especially for pensioners, this is extremely hard. But you can't have differential rates for different categories in your society. That's got to be addressed again by other means that can compensate in one form or another. I think a lot of discussion and work is taking place as to why South Africa saves so little, or is ready to spend so much when they don't have. But I think a key factor in that must be your unemployment rate. If you have this level of unemployment, you are not going to get a very high savings culture. So people are spending on necessities because of the number of people that people support. Is savings a factor? Absolutely. Part of the challenge that we have as a country is because of our relatively low savings ratio, we depend on the savings of other countries to come in and provide the financing for the things that we want to do around infrastructure or grow our economy, which makes us vulnerable to other people's or other countries' economic state. So we have a savings ratio on general at about 14, 15%, sometimes a little lower, sometimes a little higher. But if you want to be self-independent as a country on the kind of developments we want to take in our own economic infrastructure, it needs to be at about 25%. So there's a big gap. And part of it is a challenge to our earnings, a challenge to our the incentives to save, and so on. So it is a very important question that we certainly pay attention to. I'm looking for somebody who hasn't asked. Okay, we'll go back to you, Mariam, and then France. And then
Thank you. Was there any discussion at the meeting about another rate cut?
Just to respond in two ways. First of all, the decision is unanimous, so we have full agreement on the decision. The question of a rate cut in terms of taking a decision about a rate cut for now, and that's why if we look at the statement we say at this stage, we certainly discussed whether it was appropriate or required, and there was also an assessment of our proactive decision to reduce the rate at the last meeting, but a clear agreement that at this stage, no, it would not be appropriate. France?
Well, I was going to ask that.
We can skip it then.
But I will ask instead, was there any discussion of a rate hike given...
No.
Okay.
Yes, sir.
Pat McGrody from the Wall Street Journal and Dow Jones. You mentioned the recent round of quantitative easing by the U.S. Federal Reserve in your statement. Could you talk about what impact you think that might have on the value of the rand over the medium term?
Well, it's very difficult to tell. What we're seeing is that with the quantitative easing, the likelihood, and that's why I elaborated a little bit on the depreciations around the different currencies and a possible question of whether the rand has differentiated itself or decoupled a little bit from the euro or the US dollar and linked to the euro. The question is how much outflow will there be? And I think that's the challenge. What we're seeing immediately afterward was very significant inflows into the bond market. Many other emerging markets saw similarly. And how sustained that will be. So for us, it's a question of whether there's a negative impact. We don't see it negatively. We actually look at it to say, if this will help the United States get some growth, then it's got to be good for the world. Is there a way of breaking this synchronized downturn? I think it's been a very bold move by Bernanke personally, and I think that if it has the ability to address some of the domestic issues in the United States, then so much the better for all of us. So will there be an impact on us? Yes, I think that we have seen, but whether one can attribute it absolutely to that reason, because don't forget there's been a range of decisions over the period. You've had the Japan, you've had the ECB, you've had the question of the Fed easing, and it will always be something that's difficult to determine in the absolute, but certainly inflows into emerging markets there certainly was an immediate response. But these things tend to respond and then draw back a little bit. So it's, in my view, it's too early to tell in the total, but if it has a positive impact domestically, then it has to be good for the rest of us, in my view. Other questions? Anyone? Yes? No? Anything that anyone would like to add? Yes?
As the international markets begin to stabilize, is it possible to sort of expect in the future for our currency to go back to the range of 7 rand to the dollar at all?
There's the one thing about the rand, is it is volatile and moves in both directions with equal vigor. It just depends on what's happening at that time. So, yes, there is a question, and there are commentators out there who would say in certain circumstances, you know, one of the reasons that you saw for strengthening of the currency before was that there was a huge wall of money that moved into emerging markets in both equities and bonds, in that time, particularly in equities, and that had an impact on the currency. But what actually impacts and why and the amount of movement in the rand is very unpredictable. But it might be useful just to give some numbers of what the trade is offshore and the role of the rand in the international markets. Dan, would you like to do that?
Just to add to that before that, I think essentially the question would be also in response to the previous question, how market analysts and how market participants and investors assess the likely success of these various measures that have been implemented. If they think that they will work, that is likely to help investor sentiment and might result in a so-called risk-on trade being put on, and that would generally tend to see increased flows into emerging markets as such. But with regard to the rand and why it becomes very difficult to be very clear and to know how exactly the movements might be and to what extent the rand could trade at those levels. The rand is an internationally, in fact a globally traded currency, but which a much smaller market than the other currencies that are globally traded. To that extent, we are influenced by being an emerging markets currency, we're influenced by being a commodity currency. The average daily turnover in our market here for the spot market is probably somewhere around $3-4 billion dollars. And to that extent, it's very small compared to the big globally traded currencies such as the dollar and the yen or sterling or the euro. So to that extent, we very much, because we're an open economy and are linked through trade channels and financial channels to the rest of the world, very much depend on various other factors that happen in the international market. It's very, very difficult to know at any particular point in time which weights and what exactly, to what extent would influence the rand. So that is something that a whole host of people are paid a lot of money to spend their lives trying to figure out what would influence the trading in the rand. It's a very, very difficult call.
Any other questions, Ms. Yolanda?
Question on the webcast, Governor, from Peter Montalto. If the current account does not narrow from these levels, do real rates need to be higher? Thank you.
Ms. Setchen? How are you, Peter?
Obviously, Peter knows the answer, that in considering the monetary policy stance, we consider a variety of factors. We don't just look at one indicator. In this case, he is talking about the current account deficit. You would be aware that we would look at our own projections of inflation, what we think are developments in international markets, what are the international economic developments, and we would look at our own growth prospects, and based on that variety of factors, we would assess what the inflation outlook is for South Africa and formulate an appropriate monetary policy stance. We can't formulate a monetary policy stance based on one economic variable.
Any other questions? if I could then just first of all take the time to welcome the front row, who, for those who are not aware, these are the winners of the Monetary Policy Committee Challenge, and we'd like to thank you for participating and welcome you here. It is Matthew, yeah, Ompile, and Khomotso, Bianca, and Paige, and your teacher and principal. I think congratulations to all of you for being participant within the challenge itself, for winning, and for the team that supported you, Delian and her team. It really is fantastic that you've done as well as you have, and we really appreciate you coming through to be here with us today, and look forward to the interaction with you afterwards. And to everybody else, thank you for coming through. We will see you in November, all things being equal, which, as we know, they usually are not. But we will see you in November. Thank you all very much indeed.